While retail traders are busy analyzing lines on a chart, the real decision makers are sitting behind closed doors in Washington. The Federal Reserve is about to drop a financial hammer that could liquidate millions of leveraged positions overnight. This isn't just about inflation anymore, it's a calculated liquidity trap. And if you don't understand what's coming in the next 48 hours, your portfolio might just become collateral damage. To understand the scale of this upcoming liquidation, we have to look at the massive accumulation of leverage in the market right now. Millions of retail accounts are overexposed, betting on a summer rally. But the Federal Reserve's internal data suggests that liquidity is drying up faster than anyone anticipates. When the central bank updates its policy, it's going to trigger a domino effect, hitting stop losses and forcing liquidations across the board. Look at the on-chain data. Right now, Bitcoin and Ethereum whales are quietly moving their stables into cold storage, while retail investors are dumping their bags into high-risk altcoins. This decoupling isn't an accident. The smart money is positioning for a massive dollar squeeze. When the Fed pulls the plug on net liquidity, the exchanges will experience a sudden supply shock. If your assets are sitting on centralized exchanges right now, you are literally playing Russian roulette with your life savings. It's not just crypto. Look at the equity markets. Major tech stocks are trading at absurd valuations, completely disconnected from economic reality. Insiders are quietly offloading billions in shares, while the media keeps telling you to buy the dip. This artificial pump is designed to trap late-stage buyers. Once the credit default swap market begins to price in the Federal Reserve's next rate decision, the correction will be swift, brutal, and unmerciful. So, how do you play this market without getting completely wiped out? The first rule is simple: preserve capital at all costs. This is not the time to be a hero and catch a falling knife. Smart money is heavily rotating into short-term treasury bills and building a massive dry powder reserve in cash. By staying patient and liquid, you position yourself to scoop up generational assets for pennies on the dollar once the margin calls peak and the dust finally settles. To truly understand why this liquidity vacuum is happening, we have to look directly at the central banks, specifically the Federal Reserve. For the last several years, the global economy has been floating on an artificial ocean of printed money. Quantitative easing pumped trillions into the financial system, driving every asset class from speculative tech stocks to high-risk altcoins to unsustainable all-time highs. But that party is officially over. Right now, the Fed is aggressively running quantitative tightening, draining over $90 billion a month out of the banking sector. When you systematically suck that much capital out of the system, high-risk, high-leverage assets are always the very first to face execution. This isn't a random market correction. It is a calculated, engineered liquidity drain. And if you think this chaos stops at the stock market or crypto, you are completely miscalculating the scale of this crisis. Look at the commercial real estate sector. Billions of dollars in low-interest loans are coming due, and refinancing them at today's brutal interest rates is mathematically impossible for most property owners. Default rates are already ticking upward quietly behind the scenes. The mainstream media won't talk about this until the dam completely breaks, because their job is to keep the retail public calm while smart money exits the building. They want you holding the bag at the absolute top, while the institutions quietly position themselves for the massive short. If you are blindly buying the dip right now without looking at the underlying debt data, you are walking straight into a meat grinder. What most retail investors fail to grasp is how the modern liquidation engine actually works. In the era of high-frequency trading and algorithmic execution, market drops are no longer slow and gradual. When a major institutional whale or a highly leveraged hedge fund gets forced into a margin call, the system triggers automatic market sell orders across multiple exchanges simultaneously. This creates a violent domino effect. A drop in Bitcoin triggers liquidations in Ethereum, which instantly forces liquidations across the entire altcoin market and spills over into the equity futures. Algorithms don't have emotions, they just execute. They will ruthlessly hunt for liquidity pools, driving prices down to levels that look completely irrational on a chart, purely to flush out the remaining leverage before any real accumulation can begin. This is exactly why the narrative you hear on financial news networks is completely detached from what is happening on-chain and in the order books. They will tell you that the bottom is in, that the worst is behind us, and that this is a once-in-a-generation buying opportunity. But look at the volume. Look at the smart money flow indicators. The big players aren't buying this rally, they are using these minor relief pumps to distribute their remaining bags to eager retail buyers. It's the classic distribution phase of the market cycle, disguised as a new bull run. If you don't learn to read the institutional footprints and instead rely on talking heads on television, you will remain the exit liquidity for the elite until your account hits absolute zero. So the question isn't whether a crash is coming, the data shows it's already in motion. The real question is, what are you going to do to survive it? Because in a market ruled by algorithms and institutional whales, hope is not a strategy. You need a cold, calculated game plan. If you want to stay ahead of the next big crypto wave, make sure to subscribe and turn on notifications. See you in the next report.